Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which I want to discuss a very particular aspect of trading, and that's volatility. When we place trades, or when we establish a trade setup, we are looking at a number of different things, and as we should. We're looking at technical considerations, fundamental considerations, market condition considerations, and we have to forecast a objective, a target. We want to know where to put a stop, what time to get in on an entry with the specific edge that we have, and there's a very complicated web of aspects that go into each individual trade. However, I want to whittle it down to one very important aspect that is often overlooked, and that is specifically the expectations of volatility. Now, when we look at setups like the Euro USD, this is actually a 2-hour chart. You can see it's turned itself into congestion. A lot of people will look at this and say, well, there's going to be a breakout, and we're going to have a forecast for how far it's going to go, what direction it's going to go, where we're going to place our stops. Similar scenarios going on for the yen crosses, looking at the dollar yen, euro yen, looking like it has some congestion, potentially could turn to a reversal. People are looking, in other words, a couple steps ahead. Same with the US dollar, same with equities. All right? But I want to look at specifically the probability of volatility. I want to look specifically at the probability of a breakout or high-level activity, not necessarily the direction that comes afterwards. First, appreciate the volatility. Why? We'll discuss in just a second. But one thing that is particularly appealing about simply forecasting volatility rather than going all the way through the entire thing, including direction, including stops and targets, including the momentum that comes afterwards, is that it's actually much easier to benchmark the probability of a higher level volatility that can force a breakout or conditions of low volatility. Why? Because we know through general conditions in markets, whether we have a consistent low level of volatility and a lack of actual momentum for forcing volatility, we can also see, very importantly, catalysts, things that would actually jumpstart volatility. And if there is an absence of meaningful catalysts that can tap into individual currencies or currency pairs or broader markets as a whole, then we know that there is a much lower probability that you do have a breakout. Rather, we would look for a range setup. All right, so we can start first in that top-down approach, looking at, let's say, a Euro USD and appreciating it for a possible range setup. Then we apply a range strategy, which in those types of market circumstances would be a better approach. It would have a material probability skew in its favor. But looking at the Euro USD and using this as certainly a great benchmark for what's coming up ahead, it's looking more like a possible breakout scenario because we have key event risk on the euro side, and of course potentially offering us follow through. On Friday we have US data. All right. This combination of catalysts tells us that there is a high probability of very volatile markets. Does not necessarily imply direction. We have to establish our fundamental forecast, what the market expectations are, what scenarios would actually appeal or benefit from certain outcomes for the euro. But we know that there is a high probability, at the very least, of higher level activity. All right, and with that, we can adapt. We can make different trade strategies. We can look for, instead of range trades, breakout trades, and wait for either the high end of this up at 136.25 or below 135.25. We can look for a break from one of those levels with the proper volatility. All right, so knowing volatility and benchmarking volatility, we have a much higher probability scenario, we have a better trading approach, and we in turn put ourselves on a much better track for the trade. All right? Euro USD is obviously a great one. You can look at other pairs like Euro Pound, which is kind of stuck between this congestion level. Is this trend line down here support, or is this previous support acting as new resistance? Well, knowing that volatility is coming along, there's a good probability that we actually complete this. We actually decide one way or the other which break or which trend is going to develop. You can look at pairs like euro-yen. Similar situation. However, I think that this is probably going to have a little bit better influence or response to another volatility catalyst in Friday's U.S. payrolls, because that's the kind of event risk that can tap into yen crosses and general risk trends. All right, so we can isolate what volatility event to look for as well. That's a very important component of this analysis. Knowing that we also have, let's say, a Bank of England rate decision, which I'll talk a little bit more about in today's trading video, but this actually has a very good probability of generating volatility on its own, because while it does not necessarily have an update when there is no change to monetary policy, any sign that the central bank is trying to back off from the exorbitant rise in the pound, because it has appreciated very aggressively, offers us a very substantial threat that the pound can drop off aggressively. So while it is maybe a lower probability, knowing that that scenario is there with that event risk and knowing the volatility potential, we can pay attention to pairs like pound dollar. Right? And we can see how aggressively this pair has risen and how exposed the pound is. The upside might be capped, while the downside is exposed to a greater level of volatility. Right? And there's also another aspect to volatility that we've discussed on and off in the past, and that is that certain pairs or certain currencies appreciate the higher or lower levels of volatility, namely pairs like the carry trades like euro-yen, and really the yen crosses in general have even further leveraged their exposure to traditional risk trends, while carry trade has deviated somewhat. I think one of the more interesting ones, though, and something I've pointed out recently, is the U.S. dollar. Right? The U.S. dollar, it does much better as a response to volatility. Interesting, because the past week and 2 weeks, we've had some pretty tight congestion on this, and now we're looking for the possibility of a breakout. Will we get a breakout? Well, volatility has proven itself in the past to be one of the key catalysts for guiding the greenback, due to likely its position as a reserve currency, and obviously when volatility is increasing, we use volatility as a measure of quote-unquote fear or risk, and people will naturally trend towards a safe haven like the US dollar when they perceive a greater risk or greater fear in the FX market. Well, as you can see here, this is the FX Volatility Index. You often get a leading signal from the volatility reading, and that has been more so as of late. This rise here, the eventual top, these swings have come earlier on the volatility side than they have for the US dollar. We'll note that we've had a break higher here in the FX Volatility Index, and the US dollar has yet to make its move. It's not a guarantee, but using this relationship to simply volatility, the level of activity, rather than activity and direction and the other aspects of the trade, we have a very simplistic approach that we can work from a foundation of better probabilities. All right? So appreciate volatility what it is. It can offer you a leg up when you're placing your trades, and it can help to really refine and simplify what you're looking at, sometimes even offering you a complete setup, or almost a complete setup, all on its own. All right? Well, hopefully this helps you with your FX trading. We'll do another FX strategy video tomorrow.